The US Tech 100 index on the IG platform has returned around 35% so far this year, with many names in the technology sector scaling fresh all-time highs. But the stellar performance was partly thanks to the sell-off in the fourth quarter of last year. So can 2020 bring a repeat of this year's strength? Joining me to discuss is Darius Dale, Managing Director and Partner at Hedgeye, who is in New York. Darius, great to see you. Now, before we look ahead to next year, can you just remind our audience of what's been behind the rather impressive returns for the tech sector in 2019?
Well, thanks. It's a pleasure to be here. So we'll start with a idiom we learned from Yale professor Benoit Mandelbrot, who's the godfather of fractal math. What matters is the particular, not the average. So when you look at the sort of the very, very lofty returns of the U.S. tech sector here in 2019, I think it's really important to go back and sort of sequence where those returns came from. So we think about the world of regime segmentation space. Quad ones where growth's accelerating, inflation's decelerating. That's really positive for tech. That's really positive for risk assets broadly. We were in quad one in Q1 of this year, and sort of 43% of the year-to-date total return for the tech sector occurred in Q1 of this year. We transitioned to quad three in the second quarter, where 16% of the return occurred in this year. And then we also transitioned to quad three in the fourth quarter, where 32% of the sort of 46% year-to-date total return through yesterday's close occurred. And so the only environment where tech tends to do well, and it's not a sort of equity sector or style factor overweight here in the U.S. markets, is quad four, where growth slowing and inflation slowing at the same time. And only 9% or 400 total basis points came of the tech's 46% year-to-date return came in quad three. So, there's risk to be managed in both directions, and we definitely think there's going to be a lot of risk to manage as we head into the first half of 2020.
Yeah, so do you think the returns that we've achieved this year can be repeated in 2020? I know you talk about the quads and the way you look at the market. How does that translate into your view of the markets for next year?
Yeah, so just starting where we are here in Q4 and thinking about the transition in the first half of next year, the simple answer is no, we don't think the returns can be repeated, at least not for the beginning part of next year. There's a growing divergence between sort of tech sector earnings and a growing divergence in terms of tech sort of prices, if you think about the stocks relative to the outlook that we have projected. So sort of thinking about there's sort of 28 conditional factoring setups within the context of our GIP model, growth, inflation, and policy, that sort of house those four quadrant regimes, and only 5 of those 28 conditional factoring setups are negative for tech. We're actually heading into 2 of those 5 for the first half of 2020. That's a scenario where you go from quad 3, where growth's slowing and inflation's accelerating, to further into quad 3, so a second consecutive quarter of quad 3, if you will, and then again a secondary transition in the second quarter of next year, a likely transition rather, into quad 4. Those tend to be 2 of the worst sort of economic regimes for the tech sector investing, and investors' willingness to take on additional risk in this particular sector. So we definitely think tech is likely to sort of start to fade and underperform the broader market, and it could in fact lead the broader market down in this type of regime.
So this year, of course, the market, and particularly the tech sector, has been highly sensitive to these developments around the trade war. We know the US and China have come to this phase 1 truce, but it's not an issue that's going to disappear, really. So, I mean, how would you think this plays out in terms of tech sector returns in 2020?
Yeah, so I mean, again, we're very quantitatively oriented, cycle-aware investors. We don't necessarily have a view on the trade war. We obviously understand it's had a depressing impact on economic conditions, and it's obviously had a really positive impact on market sentiment here in Q4. Without any ability to forecast sort of the further developments, we will say this: we have a team of political analysts in D.C. That are quite informed, as well as informed as anyone on these particular sort of regimes or these particular topics. And what they'll tell us is that it's very unlikely that the U.S. and China, sort of reach a phase 2 agreement. So what we see in terms of what's been on the tape here in phase 1 is probably it. There actually could be some sort of consternation associated with the actual, signing and implementation of phase 1. So that presents itself as a market risk heading into next year at the same time where these sort of broader economic cycle conditions are actually deteriorating for tech. And if I may add one other thing we haven't touched on, again, is tech sector earnings. So if you look at the Q3 earnings to date, and obviously the guidance companies have been giving to, in terms of Q4 and 2020, it's not been positive. Techs, the margin squeeze that we have projected for the U.S. economy broadly is actually something that's really negatively impacting the tech sector more than most. So if you think about, Q3 earnings, just as on a reported basis, tech sector revenue growth was the second fastest revenue growth of all the sort of 11 sectors you can track in the S&P 500, whereas tech sector EPS growth at down 5.3% was actually the third worst rate of change of EPS growth, and we actually see that continuing into the new year. So, sell-side analysts have very lofty expectations for revenue growth and EPS growth as a function of companies not necessarily broadly taking down their numbers. We suspect the economic regime we're heading into will sort of force those management teams to do what we expect ultimately to be reflected in the prices of the securities.
So what are your models telling us about where to find value when we dig a little deeper into the tech sectors? Which are the pockets that you really like?
Yeah, absolutely. So it's not necessarily about value. It's really just about being positioned according to what we call the machine, i.e. the institutional investment flows are likely to flow into and out of, just based on the economic regime that they're going to be receiving signals from. So with respect to this sort of pending quad 3 to quad 3 transition for the first part of 2020, our back test work suggests that IT services is a space where investors can sort of hide out within tech, whereas you want to be short software and want to be short semis in the context of that.
All right, and I know you don't cover individual stocks yourself, but your tech team has a few bearish calls, I believe.
Yeah, absolutely. So our tech team is quite bearish. As a macro team, we're quite bearish on software broadly as it relates to the broader business cycle. That's much more of a longer term call as it relates to some of the lofty valuations there in relation to the profit outlook and the ultimate sort of what we consider to be the total addressable market for a lot of these companies, i.e. being much lower than what they're and analysts are currently projecting. So our tech team led by Amy Joseph has really negative views on Medallia, sort of Upwork. And Smartsheet as well. Again, it's not necessarily just trying to drill down into specific names, but really the risk management calls to necessarily not be, overweight tech heading into the first half of next year. And if you have to be if you're a tech dedicated investor, you want to be crowding into the IT services names and away from some of these high flying, high valuation software and semis multiples.
That was Darius Dale, Managing Director and Partner at Hedgeye. I'm Victoria Scholar, and thanks for watching IGTV.